So welcome everybody who is on the call, and good morning to you, or for those of you who are probably further east, good afternoon. This presentation today is being brought to you by the Canadian Climate Law Initiative and Chartered Professional Accountants of Canada on helping audit committees navigate the changing climate governance landscape. For those who don't know, the Canadian Climate Law Initiative is a cross-disciplinary initiative that advances the understanding of governance of climate-related financial risks and opportunities through research, knowledge sharing, and dialogue. CCLI is established at the University of British Columbia and York University and is partnered with the Commonwealth Climate Law Initiative. Next slide, please. CCLI has created this guidance that we're referencing today, and it draws together current legal and best practice guidance for audit committees to assist them in taking a leadership role in effective climate governance. CPA Canada is currently working with CCLI to create a series of pragmatic pieces on this CCLI guide. And we're going to work with an expert committee to try to create pieces that help audit committees to actually implement the guide and understand it more effectively. Next slide, please. It's going to be important to understand today the role of the audit committee in the context of the role of boards in climate change. The board of directors is responsible for the oversight of the company's strategic business plan, risk management, and integrity of its public disclosures. Audit committees are delegated responsibility by the board, and I think that's important. Delegated responsibility to undertake detailed scrutiny and oversight of financial reporting processes that include reporting and disclosure, monitoring risk, audit, and financial markets. That context is important. The role of the audit committee will vary substantially or may vary substantially depending on how the board has delegated responsibility within the board. The audit committee has a key role in determining how the company's strategies and financial results are communicated to investors, regulators, and other stakeholders. But specifically, their role related to climate change may vary. Our panelists will elaborate on these responsibilities today. I also think it's noteworthy that neither the board nor audit committees need to be climate experts. They need to know enough and understand enough to ask the right questions. If too much information is provided to them, then the audit committee may be left wondering if the information is actually speaking to them. Now I'm going to pass this on to our three established panelists at this stage, at this point. First, a short introduction, and this really is just a small part of their significant backgrounds and what they bring to the table. Roopa Davé is a partner with KPMG's Sustainability Services practice. Having trained as an accountant, Roopa focused her career on sustainability because she believes there's a role for business in addressing social issues like climate change and human rights. The next panelist, Meghan Harris-Ngae, is an associate partner at EY and leads the climate change and sustainability practice for Western Canada. She has over 16 years of combined international and local experience in climate change, environmental health and safety, ESG, and international government relations. Finally, Lisa DeMarco is a senior partner and CEO at Resilient LLP. She has over 25 years of experience in law, regulation, policy, and advocating relating to all aspects of climate change and clean energy, and she's an experienced board member. Each of our presenters has worked with boards and internationally to be able to bring a broad perspective to us today. Now we're going to move forward, and we'll start with Roopa.
Thanks, Gigi. And great introduction, and welcome everyone, and happy to be here. So what I'm going to focus on for the next couple of slides is really around that responsibility that's been delegated to the audit committee with regards to financial reporting processes. As an audit committee member, I think it's really important to stay apprised to the developments, and there's been some interesting ones in the past few months with regards to financial statement considerations and the topic of climate change. So I'll try to avoid getting too technical, but provide you with an overview so you're aware and can look into it a little bit more as it relates to your role. So the first update or item I'd like to raise is that of the educational material that was released by the IFRS Foundation in November of 2020. So the IFRS Foundation put out some educational material really driven by the increasing interest by what they say are IFRS stakeholders, but predominantly the investor community, on how climate change might impact or potentially impact business models, cash flows, financial position, and of course, financial performance. So this educational guidance really provides, illustrative examples of how climate-related considerations might play into your application of specific IFRS standards. And so they actually walk through a number of these standards and topics like estimates and significant judgments, going concern, impairment of assets, and the types of questions management might ask in preparing their accounts. They go through what management's responsibilities are and in more detail, I think, raise a really important topic, and that's of judgmental materiality. And this is really where I think the topic of climate change can get complicated and an important place for all of us as practitioners and management and board members to consider. So they really speak to the idea that qualitative factors, so when you're thinking about materiality from a judgmental perspective, so qualitative factors like the industry in which the organization operates, or even more specifically, investor expectations of either that industry or of that company in particular, may actually make some types of risks, such as climate-related risks, material, which may warrant, disclosures in financial statements regardless of their numerical impact. So again, this topic of materiality and judgment and qualitative materiality is absolutely at the forefront when considering financial statement preparation. Next slide, please. Very much related, earlier in the fall, so October of 2020, the International Auditing and Assurance Standards Board released a climate change staff practice alert. And this audit practice alert is really in relation to the audit of, again, financial statements, and is providing guidance to your auditors when looking at a set of financial statements, regardless of whether it's prepared under IFRS or another financial reporting framework. And again, the IASB raises the fact that they've put this practice alert out there because of the evolving and increasing expectations and priorities of investors, and how that might affect how they perceive climate-related risks and an entity's financial statements. So again, how it might impact their decision-making, which is really what materiality is based on. The staff practice alert goes into a little bit of detail on the specific industries that are more likely to be impacted by climate change. And I think these are not a massive surprise, but financial services, energy, transportation, amongst others. The practice alert also describes quite clearly what management's responsibilities are. So again, it's not, the onus isn't entirely on the auditor, but then goes through in terms of what the auditor should be asking and what their responsibilities are. Again, very much related to this topic of judgmental materiality, and really what kind of structural shifts might trigger some questions around what could be considered material for disclosure in the financial statements. So what does this mean really as an audit committee member? So if I were in your shoes, I think the important thing to think about at a most basic level would be to begin with asking management, are you aware of this material, this educational guidance? Possibly also asking your auditor if they're aware of it and how this is being, dealt with, particularly if you're in any of the industries raised in the staff practice alert. Another question that would be important to ask as an audit committee member, just in relation, again, very much to the financial statements and climate change considerations is, is the company that you work with, have you set any public commitments around climate change? and other sustainability disclosures that you have out there, and have those been considered? So asking management, have those public commitments or any other disclosures that you make on climate change, have those actually been considered in the preparation of your financial statements? So an important sort of shift in the expectation around financial accounts, and happy to get into the Q&A on where we see this going, but definitely a lot of movement in this area in the fall of 2020, and something that as an audit committee member you'd want to be aware of. Next slide, please. More broadly, as we think about the evolving role of the audit committee, I think what I just spoke to were sort of some of the basic things you may want to be considering as a member of the audit committee. But what we also see is a possible leadership position for audit committees to take in terms of discussions specifically on this topic of climate change. And as your company, your board, and your governance around this topic matures, there's some really important discussions that should be happening and can be led or started with the audit committee. So, first, as the audit committee, you can very much support management in the development of an internal control framework that identifies the financial risks that arise as a result of physical and transition risks. And Megan's going to get into what a physical and transition risk is in more detail if those are new terms to you. As part of this control framework, I would also say, establishing accountabilities around climate change is a really important part of that discussion. Second, as the audit committee, you can begin discussions on incorporating the climate change lens across the 3 lines of defense, of course, business ownership, risk management, and oversight of internal audit, but also, beyond that, into your external audit relationship possibly as well. Third, very much as the audit committee, you can lead the discussion on the incorporation of climate-related disclosures in the suite of corporate disclosures. So, again, I've spoken to the topic of financial reporting, but a lot of climate-related disclosure is non-financial in nature, but provides the context about your strategies and your resilience. And so, as the audit committee, you're well placed to have those conversations and provide the oversight on that non-financial information as well. And last and very much not least, as the audit committee, you have the opportunity to really monitor progress against any external commitments around reduction of carbon emissions or net zero commitments. And again, very much similar to what I said before, but really ensuring that consistency across all aspects of reporting. So with that, I will pass it over to Megan to take you into the rest of the presentation.
Thanks, Roopa. So just to follow on from some of the comments that Roopa made in terms of the role of the audit committee, one of the questions that gets asked quite regularly, and I know Roopa and I both get asked this question, is, at different stages of organizational maturity, what is the role of the audit committee? So what's important to recognize is that the practices that we're recommending be part of the audit committee responsibilities are considered to be interactive rather than linear. And it's really meant to feed into better developing other practice areas. So if we look on the right side here, and Roopa covered some of these, looking at the identification of significant material risks and opportunities as they relate to climate change, measuring climate-related risks and opportunities, supporting the board in the development and implementation of a climate strategy, including a risk mitigation strategy, and then disclosure of strategies, financial metrics, targets, and progress in meeting goals, which Roopa covered. And really what's important to recognize here is that at different stages of organizational maturity, the amount of focus on each of these buckets varies. And so an example would be that an organization maybe at an early stage of maturity on assessing climate change, may have some interdependencies across these different buckets, and the amount of focus on, for example, opportunities may be less than risk, and the level of risk for different types of organizations, as well as organizations at different levels of maturity, will vary. So for example, in the oil and gas sector, risk is definitely high on the radar of the audit committee just as a result of transition risk, which I'll cover in a minute. So what's important to recognize here, and the key message, is that these are meant to be interdependent, not linear, and in a cycle of continuous improvement. The other important factor here is that these responsibilities or areas of focus really mirror the existing core functions of financial reporting regarding the risks that are reflected in the financial statements and MD&A. And Roopa covered some of the developments in that space, and we expect the focus in that area to continue. Next slide, please. So I'm just going to level set on, Roopa mentioned physical and transition risks. So just going to introduce, for those of you that may not be aware of TCFD, also known as the Task Force for Climate-Related Financial Disclosures, and why that's important, and just cover the role of the Audit Committee in relation to TCFD. So TCFD was developed in December 2015 by the Financial Stability Board. And really, they established TCFD to develop recommendations for efficient and effective climate-related financial disclosures to promote informed investment, credit, and insurance underwriting decisions, and to enable stakeholders to understand the concentrations of carbon-related assets in the financial sector and the financial system's exposures to climate-related risks. So what this means is that at the end of the day, the reason that the FSB looked at the establishment of this task force was because they recognized that climate-related risk could actually have the potential to destabilize global financial markets. So since 2015, TCFD, being a global initiative, has been looked at by regulators, securities regulators. I think we'll touch on a little bit on that later. But at the end of the day, it's being used by investors and issuers to really assess, manage, and disclose climate change risks to companies and portfolios. And so to date in Canada, it's voluntary. It was endorsed in 2019 by the federal budget. In the UK and Australia, the governments are now making disclosure against TCFD recommendations mandatory, which is a significant development. What we're seeing is companies, investors are focusing on climate-related risk, but at different levels of maturity. And so the recommendation here is that from TCFD is that both companies, investors should disclose how they govern climate risk, carbon emissions, and emissions intensity to decrease emissions over time. It's expected that information about climate governance and risk management be included in all financial filings, and Roopa again touched on a little bit of that in terms of what the developments are in that space. And when material, the disclosure related to the implications of climate change on strategy and the metrics and associated metrics and targets should be provided in the financial statement. Now, before I move to the next slide to talk a little bit more about the recommendations, what's important to recognize is that the TCFD recommendations are quite robust in nature. What it does is they split climate risk into two buckets. And I'm going to avoid going into too much level of detail, but just at a high level, they split climate risk into physical risk and what's called transition risk. So physical risk would be the actual impact of the climate changing on your organization. So an example of that would be some of the forest fires in California had a significant impact, for example, on PG&E. And so that's an example of a physical climate risk affecting the stability of the organization and obviously having significant financial risk attached to that. Transition risk covers a myriad of things, including policy changes. An example would be carbon pricing. So in Canada, most recently, most of you may have seen the announcement that the price of carbon is going to be set at $170 a ton. That's a significant risk as it relates to that would be considered to be a transition risk. The other one would be the energy transition that's currently occurring. So in working with a lot of oil and gas companies, for example, who are affected quite dramatically by transition risk, they're looking at, forecasted reserves, the production of those reserves. How is the energy transition going to affect their organization? And most of that energy transition that we're talking about is triggered by climate change. The other one would be legal and regulatory risk. That would fall within the transition bucket. So you can see that a lot falls within the transition bucket, and most organizations in Canada, with the exception of a few, would be very much focused right now on transition risk, and there will be some that will start to look at the impact of physical risk as well. And what's important to recognize is that the TCFD does drive towards running scenarios and looking at quantification of financial impact of these risks. And so that's a very important aspect of TCFD, and that also links to the role of the audit committee in looking at that financial risk exposure. Next slide, please. So I won't cover the recommendations on the right-hand side of the slide in detail, but you can see that the recommendations provided by the TCFD are split into 4 different buckets. So looking at governance, strategy, risk management, and metrics and targets. And so, you know, if you don't have access to it, it would be recommended that you take a look at these recommendations in detail. As I mentioned, securities regulators are debating the requirements of TCFD and disclosure documents, and we've heard that from the securities regulators in Canada. And I mentioned that in the UK and in Australia, they've already made this mandatory. There are recommendations from the IFRS Sustainability Standards consultation process, and I won't get into this in too much detail, and Roopa covered some of this, but late last year, there was a consultation by the IFRS Foundation on standardization of sustainability disclosure. And what we're hearing from the results of that consultation process is that climate-related disclosure is considered to be the most material and most pressing to standardize globally. And so we do expect there to be some significant momentum, which we've already seen from some of the material that Roopa covered. I mentioned that there's a focus on setting carbon reduction targets, and some of that is being driven by carbon pricing. This is a significant risk to some organizations as we think about 2030 and 2050. When you look at exposure to carbon pricing, especially in emissions intensive industries, you know, thinking back on what capital cost is going to need to be put into place to actually deal with the impact of that carbon price, it's actually quite substantive. And so that announcement that came out late last year has actually had quite a sizable impact on, you know, the role of not only the audit committee, the board, executive management teams in looking at what they're going to do to reduce their financial exposure associated with that pricing, which would fall within the transition risk bucket. You know, as momentum changes or accelerates on climate change and the impacts grow, we expect to see enhanced disclosure, you know, risks of asset impairment, as Roopa covered, and a little bit of, you know, definitely looking at material financial risk. And so you think about the role of the audit committee and how the role of the audit committee will shift over time as this momentum grows. And so that's why it's really important to understand the impacts now. And lastly, but not least, the audit committee will also have accountability for assessing the content, quality, and progress related to climate-related risk disclosure. And that's not just on the metrics and targets, but it's also on looking at the financial, you know, financial accounting associated with the climate risk, which is it sounds, I'm not going to oversimplify that because that's not an easy exercise to do, to really understand the current and then future state of climate risk in financial terms. And so you can see how, again, the role of the audit committee and how important climate is going to be in their remit, how that's going to shift over time. So I'll pass it over to Lisa.
Thank you so much, Meghan. And what I'd like to do now is cover the legal framework in 2 parts. The first specific to audit committees, the second specific to climate change, and then talk about some very pragmatic governance strategies. And I'll refer you in advance to the guide itself, which is really outstanding. So the CCLI guide at the beginning of this presentation is very helpful. So let's start with the legal framework pertaining to audit committees. And this isn't anything new for many of you. You'll all be familiar with the National Instrument 52-110 specific to audit committees, which provides guidance in and around what audit committees should be looking at. And there are a number of aspects that can apply in whole to climate-related risk. Similarly, there are guidance documents, National Instrument 51-102, specific to continuous disclosure obligations that really make the requirements a living document, not something that you do once and forget about it. And we're seeing a lot of issues arise legally with clients and others that disclose climate-related risk and then don't follow up appropriately in subsequent disclosures, and or have disclosures that have associated differences as they proceed. So that's something to watch out for. You've heard specifically around the obligations for public companies to prepare annual financial statements in accordance with IFRS. And the IFRS Foundation has given very specific guidance that Roopa spoke about, very specific to looking at the effects of climate-related matters on financial statements. And there are 10 international accounting standards that require disclosure of material climate-related matters and provide guidance on overarching climate-related disclosure. And as both Meghan and Roopa said, we don't think those obligations and that guidance is going to decrease at any time in the near future. In fact, we expect greater specificity and more precision in how audit committees and other financial entities are dealing with climate-related risks and opportunities. And I'm going to emphasize that last point, and opportunities. I'll come back to it shortly. Privately held companies are not exempt. Back to the last slide for 1 second. Privately held companies are not exempt. They also have the option of reporting in accordance with IFRS or the CPA handbook, which provides for accounting on a GAAP basis. And there are also specific corporate legal requirements that are particular to specific jurisdictions. There's a lot of consistency in Canada, but in other jurisdictions, there's some unique obligations, particularly in the US. So look to the country or the area of incorporation, the jurisdiction of incorporation, to look for particular obligations there as well. Next slide. Let's go on to specific climate change disclosure frameworks. The Canadian Securities Administrators put out Staff Notice 51358 2 years ago. I was part of that initiative, and certainly they did a great job at trying to compile further guidance on climate change and provide a clear indication that climate is now a mainstream business issue, that companies must disclose material financial climate risks in and around, and not just identify risk, but also identify how they are addressing them. Boilerplate is no longer acceptable. So we've seen a lot of changes come from that, and some really high watermark disclosures in Canadian public issuers, and also others that have a far way to come. Most recently, the CLI has sponsored a legal opinion from Carol Hansel, who's a well-known governance law expert in the Canadian marketplace, who has clearly indicated that there is no doubt that directors must inform themselves of the risk that climate change poses to the corporation, and I'm going to emphasize that and how that risk is being managed. If this information is not already included in management reports to the board, it's incumbent on the board to direct management to take the necessary steps to provide the information to them. And here's where I want to definitely again emphasize that risks don't only take the form of material negative impacts immediately as a result of one of the physical or transition risks that Meghan highlighted, but it also might include the risk of foregoing material climate opportunities. And a little bit of a war story here. One of the toughest jobs I've had has been being called upon by a board of directors to help management explain why they overlooked $100 million climate or carbon pricing opportunity and forewent that opportunity without any consideration or value. Those are not pleasant conversations to have. So material awareness of not just the risks, but the opportunities that are incumbent or available to corporations in the terms of financing and or transactions that are incumbent in the sector are also very, very relevant. Next slide. So what are some of the strategies that audit committees can take, or that boards of directors can take to govern climate risk? Once the risks and the targets and metrics are identified, the mandate of the audit committee is to ensure that there is appropriate oversight of the internal controls around them. So they want to make sure that there are appropriate controls over reporting, internal audit, accuracy and transparency, and I'm going to add consistency to this. A common legal problem that we see is that a company will report one thing to the Climate Disclosure Project or to Ceres, another thing in a sustainability report or an ESG report, and themes and variations in the actual financial statements. The inconsistency of reporting often can result in challenges for corporations. So consistency among the various reporting initiatives is going to be increasingly important, and in fact is an ounce of prevention worth a pound of cure strategy. Audit committees should regularly report to the board on how the company's doing with compliance and internal policies and progress in remedying any gaps or deficiencies related to climate policies and risk management systems that they've identified. Often we see where a committee other than audit is charged with governance. For example, the risk management committee is charged with governance. The audit committee still has a role to play in oversight. And so just because another committee is initially charged with governance of climate change risk does not mean that audit committee does not have an active role to play in internal oversight and internal controls. This should take the form of at least, and I think this is actually conservative, it should be a very significant focus throughout the annual cycle of meetings on environmental and social governance issues, including climate risks. And quite often we see at least one meeting dedicated to addressing climate risk specifically, not just ESG writ large. And or the board should think about authorizing the audit committee to retain outside expertise to help with assessing the risk, the impairment assessments, and year-end audits. This is increasingly the case. We've seen a number of great entities grow in the Canadian context, providing these services, both from a technical and substantive basis, and they work closely with law firms like us to assist in that regard. Last slide. Other strategies would be to look toward best practice. If you are worried or concerned about diligence, having done a survey of best practices related to significant material risks and opportunities to the business from climate change, measuring, monitoring, and reporting climate risk, and using, setting metrics, scenario testing, and appropriate characterization and taxonomies, both here and in the relevant markets, is very helpful to showing diligence. So the audit committee can work with the board to develop a very credible climate plan or strategy in light of the transition pathway, transition risks towards the appropriate climate context. And I'm going to speak very directly to what is the appropriate climate context right now. We are definitely seeing prudent and diligent companies set and adhere to climate-related targets. We have legislation in Canada that now mandates net zero emissions by 2050. We have the Paris Agreement that is really driving the agenda that looks to limit global average warming to 1.5 degrees Celsius and to achieve climate neutrality by the second part of this century. And so looking at each of those circumstances, each of those pieces of legislation or policy or treaties that are driving the initiative determining what is appropriate for the company in that timing, in those circumstances, is going to be very relevant. So for example, right now, we see material differences in the circumstances and timing for Canadian companies as compared to US companies. That will change very soon with the Biden administration. So looking at very specifically, what are the climate related financial metrics that we're going to drive towards? What are our short, medium, and long-term targets? Noting that many of these are not net costs, but are in fact net efficiencies or cost savings for the company. How are we going to measure and disclose our progress in meeting our goals? Making sure that it's very transparent and credibility is gained for saying, listen, we ran into this problem that we didn't anticipate. And this is how we're further mitigating it. And this is how we're further evaluating how we disclose this to you. What are our competitors and cohorts doing? And how are we disclosing what we're doing in the context of our industry and sector? So those are a few strategies. The guide provides further strategies, and I will turn things back over, I believe, to Gigi.
Thank you to the three of you for a fabulous presentation. We're now, I think we should be able to see more people. I've got my view on wrong because I'm not on gallery. Okay, there we go. So I'm going to open it up to questions now. I've gotten a few questions. If people would please send your questions in, or I'm not sure you're going to have the option to ask them live, but if you can send your questions in, that would be great. I'm going to start with one question to all of you, or whichever one of you wants to answer. You know, fabulous presentation. Boy, there's a lot here in terms of what audit committees are expected to do now, on top of many of the responsibilities they already have, and some of it is part of the responsibilities they already have. I guess one question is sort of, is too much being asked, and you know, how much is this going to add to their role? And I wonder if audit committees might ask the basic question, where do we start? You know, where do we start on this? So anyone feel free to jump in with that, an answer to that.
I can give a first go. You know, I think the content I covered at the very beginning of the deck is a place to start. It's completely relevant to financial reporting. So I think a lot of what we've covered has been broader, extra financial with indirect impacts on financial, but there's a lot of movement on direct financial reporting impacts. And so, you know, at its most basic level, that is traditionally the responsibility of the audit committee. So, you know, I think getting comfortable with the educational material, understanding, you know, asking the right questions around what's the exposure in your industry. Do you have cash flow models that go out 80 years that you maybe need to ask some specific questions on? Are you highly reliant on carbon intensive raw materials that are going to go up in pricing? So there's some pretty specific, you know, easier things to wrap your head around, steps to start in terms of financial reporting. But I think the, you know, the second piece of this is really that idea of, it depends of where you are in the maturity scale as an organization on climate change. And so, you know, you could be well beyond that. And so your next steps are going to be somewhere along the lines of what Meghan spoke to in terms of what those other roles are. But, you know, from my perspective, I think that's a very much a first step for audit committees.
Thank you. Meghan or Lisa, anything to add to that?
I would say from the legal perspective, we're actually seeing an initial, basically audit function of what are we doing within the corporation and what are our emissions. So actually looking at emissions data from an actual standpoint of, particularly if you're in an extractive sector or a sector that is at higher risk, it's no longer the case where you can turn a blind eye to what's going on, even if you're not regulated. So these are good places to start. Internal, basically inventory of what's going on in the company and where the emissions are and where they're going.
Okay. The only other thing I'd add is for audit committees to really take a look at, there are a number of organizations, CCLI, CPA Canada, ICD, who are all providing more education and training on this. There certainly seems to be a lot of information out there, so that may be helpful. We do have some questions that were sent in. I hope people don't mind. They've given their names, so I will use their names in terms of associating with the question. Jim Farley has said, do the standards require climate change risk on an outgoing and incoming basis? That is, the company be an emitter of nasty things, which does not affect the company directly, but these things affect near and or far neighbors, or incoming. The company is not emitting any nasty things dangerous to climate vis-a-vis itself or others, but the company is having climate problems caused by others. Do the standards require climate change risks on those areas?
I can maybe answer that one quickly. So the short answer is yes. Really what the standards or if we reference TCFD as a standard, climate risk, even if you are, say, a large emitter, so if we consider that to be nasty things, you will have an impact on the environment, communities, stakeholders outside of your organization. So that is considered to be where you have the most impact as an entity. But at the same time, climate risk, you can be affected by climate risk even if you are not a large emitter across your value chain. So within your supply chain, your stakeholders that you deal with can be affected. You as an organization, I gave the example of, again, going back to the energy sector, most specifically the oil and gas sector, and how impacted these organizations are. So in some cases, they may not be the highest emitter, but they are heavily impacted by transition risk. So the short answer is yes, it's both coming in and going out.
Anything to add for the others? Roopa?
Yeah, I wouldn't mind adding quickly, I think it's an interesting lens to think about the TCFD versus more traditional sustainability reporting frameworks. I think historically, it's very much been this inside out approach. So what is the company's impact on the environment that it surrounds and its broad stakeholder group? And the TCFD is much more of an investor focused set of recommendations, or SASB, and that is really about the environment's impact on the business and then the business's resilience to those topics. So I think that question's a really well placed question. So while you are a large emitter and that might be impacting the community around you, there are a lot of things about that impact that are going to be regulated. So indirectly, whatever you're doing on the community is going to impact your business. But I do think that lens is really important for businesses to take in, because the questions around the TCFD is really about your resilience as a business and what those impacts of those ESG type topics are on your business.
Great, thank you.
And just to granulate a little bit, when you get into the emissions reporting itself, the categorization of emissions as scope 1, 2, or 3 really highlight, is it inside out or outside in? Scope 1 and 2 are largely your impact on the climate or on emissions. Scope 3 can get into your supply chain and outside in. So there's further granulation there. And in relation to the comment that both Meghan and Roopa made around the impacts on the business broadly, even if you're not a large emitter, things like logistics on your transportation pathways might be dramatically impacted by climate change, even if you are a zero emission company.
That's a great point. Thanks. Okay, we've got another question that came in, and this is from Lynn Johnson. She sent a few, Johansson, I believe it is actually, sorry. She sent a few questions in. I will go through the first one. TCFD has provided an annual report on the number of organizations and how effective this reporting has been. 4 areas consistently appear as weaknesses across this reporting. These 4 areas include governance, A and B, board oversight, and management's role, resilience of strategy and overall risk management, resilience of strategy and overall risk management. What actions are needed to address these Achilles heels? And if not, are corporate directors at greater risk? Maybe Lisa, that's one you want to start with.
Sure. I'm going to sum it up by saying tone from the top is really quite critical to address those Achilles heels. And boy, I've never seen anything more effective than tying executive incentive pay to climate risk. It's shocking that that happens, but you actually make it a KPI on a performance metric necessary for executive compensation, and it gets addressed quite well. In terms of the specific sub-risks, governance is key, and that's within the hands of the board. There is definitely the ability to offline in between board meetings and online within board meetings, shake the climate tree, so to speak, and ensure that A, the tone from the top is there, and B, the requisite management is happening within the governance strategy. So whether or not it's relegated to a committee that's not board reporting or purely within the focus of the board is within your control.
Anything to add, Roopa or Meghan, before we get to the next question?
I can just add that just quickly on based on what Lisa said, the other thing that we've seen from a management responsibility is really looking at not just risk management in general, but how can climate risk and broader ESG risk, but climate risk be fully integrated into enterprise risk management governance and the way that that's executed within the organization, which is really, really important.
Yeah, that's a challenge and very, very important for the boards to look at. Okay, Mark Proud asked the question specifically related to the upstream oil and gas and in the oil and gas sector. What role should the board take in addressing the disconnect between specific disclosure and commitments and the actual operational execution on the ground? An example would be an emissions intensity calculations that purposely overlook the fugitive emissions resulting from surface casing vent flow. The emissions materiality under reports the actual emissions intensity.
I think Roopa and I can probably both answer this in a similar way. I'll start, Roopa, and then pass it to you. So Mark, good question. We see this a lot. I know Roopa sees this a lot because we both are in a position where we audit emissions, and what we're starting to see, and this links very clearly back to the role of the audit committee, and not just making sure that climate risk is looked at, but that the completeness, accuracy, and consistency of emissions information is reported in external disclosure documents, as well as how emissions are reported within the organization. And we're starting to see this get more attention as the regulations catch up. So in some cases, you know, looking at fugitive emissions are captured by some of the provincial regulations, in other cases, not explicitly. And so again, I think back to the role of the audit committee in maintaining that when you think about exposure risk associated with, you know, carbon pricing, for example, that transition bucket, you need to have a very clear picture of what your emissions are. You can't just look to omit it to look better, because from an investor perspective, they're looking for the accuracy in that information being disclosed. And I think what we're going to start to see more and more is that need for emissions to be audited. And from an auditor perspective, we look at the completeness of the information that's getting reported internally and externally. But Roopa can probably add to that as well.
Yeah, I think an important aspect of that, and I think you're bang on with that question, you know, that's a specific example, but there's a multitude of examples exactly like that. And so having an external eye on it, whether it be audit is an option, but even, you know, bringing in external expertise to review your data, to just bring some level of comfort for the board that what is being reported is complete, accurate, and again, consistent with peers. And having some external eyes on it, and auditors in particular, is what we're seeing is that's helping improve disclosure. Because if what you'll generally see is when you look out there at what's being disclosed, very little details provided. So an exclusion like that's not disclosed. It's really hard to even find out that exclusion is happening. So as we see this information mature, similar to financial reporting, we'll see a lot more disclosure, and that should help. But bringing in external expertise, and then I think tying back to Lisa's point of tying to management compensation, and then being very comfortable that management compensation is being paid out on high quality data is very important, and I think a role the board can play.
I'll just add very specific to that question that fugitive methane emissions in particular may pose a very significant climate carbon pricing opportunity. So when we were talking about the risk of material, financial, foregone climate opportunities, fugitive methane emissions would fall square in the middle of one of those.
Lisa, there is a question specific to you about overlooked opportunities. Lynn Johnson also sent this one in. On your point of overlooked opportunities and risks, where risk is considered as a negative driver, what caused the company to miss the opportunity? Is the perception that the climate is primarily, is there a perception that climate is primarily a risk? Is this a problem driven by the lack of sufficient understanding that there are substantial business opportunities in this area?
Yeah, I think that initially, certainly over the last many years, climate has been perceived as a negative risk that was necessary to manage to a minimal extent, consistent with comparators and cohorts and what the law required. That world has come and gone. There is significant opportunity in around progressively managing or addressing or thriving in the face of climate risks. And we have many. I take, for example, Carbon Engineering, a Canadian company engaged in direct air capture, an announced transaction with Occidental Petroleum, producing effectively net carbon negative oil. These are the kinds of opportunities that we've got in the marketplace that need to aggressively be addressed and thought about. And so what that takes, the big Band-Aid that we need, is to apply a climate lens to all opportunities, material decisions of the company. No material transaction, investment decision should be taken without having a climate lens involved.
That's a great point.
And I go as far to say that, management is negligent if they do not consider climate risk. I get in trouble for saying that from time to time, but at this point, what we know with the advent of border carbon adjustments coming into play, you must apply a climate lens to material financial decisions of prudent companies.
Mm-hmm. Well said.
I might jump in quickly on the opportunity just to help companies on addressing that. And we haven't gotten into this topic too much today, but it's often a very big topic in climate change, is that of scenario analysis. So if a company gets to a point where it's comfortable and able to start performing a scenario analysis, which is really sort of that future looking lens of potential future scenarios based on where we see actions by, our world, that is one of the best ways to actually identify, changing consumer needs, changing regulations, and that is where those opportunities really pop up. So that's a really important process to undergo for management to help them on the opportunity side as well.
Yeah, I think that's a really important point. One of the things I think we have to keep in mind, and in terms of those of us who do board education and create materials for boards, looking at us specifically, scenario analysis is one area that many organizations and many boards are challenged with doing well. And certainly something, the more we can help people do that well, the better they're going to be able to deal with a lot of these risks and opportunities, so, and recognize the difference. We got a question in the comments area from Aladdin Daikon. Thanks for the terrific discussion. Do we have much judicial guidance so far from Canada or elsewhere vis-a-vis how courts are likely to deal with D&O liability for failure to sufficiently assess, manage, disclose, etc., the climate risks? How do you see climate litigation trends playing out in the coming years? Lisa, I think you sort of started down that track, but you may have some more responses.
Yeah, there has been a burst in climate jurisprudence, not as much in Canada as there has been in the States, revolving in around PG&E and the associated insolvency events there from a known risk, and in and around the Exxon material non-disclosure events there. The CLI has a document on its website that has a great summary of the current jurisprudence. It came from a program that we did, I believe it was last February, Gigi, at Globe, and Janice, Sarah did just an outstanding compilation of the relevant jurisprudence. In Canada, the general jurisprudence in around the business judgment rule will certainly still apply, I think, to directors and officers. That being said, there is a definite obligation to act in the best interest of the corporation and address foreseeable risks in a reasonably prudent manner. There is virtually no argument at this point that climate risk is not known and foreseeable. So that's the basis of any associated claim of negligent governance. Whether or not individual directors are subject to liability, certainly the business judgment rule gives a fair amount of leeway, but given how we're proceeding and the guidance that's available and the accounting guidance that's available, particularly if you're a public issuer, you'd be hard pressed to argue that these risks aren't known and the obligations are therefore not in front of you right now.
Great, thank you. So we just have 1 minute left. I'm going to ask one final question, so we'll probably just have time for one of you to answer. Michael Tulch asked, do you foresee any possibility of standardized disclosure requirements in Canada regarding the potential impact of transition risks on assumptions made by companies within their financial disclosures? Either Roopa or Meghan, I think you can talk a bit about the IFRS proposal at this stage. Meghan,
I'll just answer quick, and then I think Roopa, your comments are valuable though too. You know, I would say the short answer to this is yes. I think we'll expect to see that. And in working with a lot of companies right now, obviously it's raised a lot of concern in terms of what that risk presents. But especially as we look at reserve life, et cetera, looking at the impact on impairment, I would say, and I'm sure Roopa is in the thick of these conversations as well within KPMG, but working with our core financial auditors to assess this is really, really critical. So I would say my answer is that it's coming. It's not there 100% yet, but it's likely to come. But Roopa, maybe add your perspective.
No, I would agree with that, and you know, we're at time, so I think that addresses it. Thanks, Meghan.
Okay, thank you. Thank you very much to the three esteemed panelists. I think this was really, really interesting and helpful presentation. Lots of great information. There's a lot out there to do in this area. I will tell the participants that this will be put up on the CCLI site as a YouTube presentation. We've also had some requests that the slides be available, and that's something we can decide with the panelists whether they're comfortable with that. My guess would be people are quite comfortable with it, and if that's the case, that will also be available through the CCLI website. So thank you very much to everyone who's joined us, and again, another thank you to the panelists. Really great presentation. Thanks.
Thank you, Gigi.
Thank you.